I would say the dramatic increase in interest rate and the subsequent sort of softening of the real estate markets has had a big impact. Certainly, uh, you know, that has been made it harder to raise capital because a lot of people
Yep.
got money tied up in deals that either are never going to get their money back, or it's going to take longer than they thought it was originally. And this is true not just in real estate, but private equity and venture, et cetera. So, but that said, man, I mean, I still see tons of people that, again, not just in real estate, that want to set up a fund and run, raise money from other people to fund whatever deals it is that they're doing. So I don't see it going away anytime soon. I see it just, growing and morphing.
You're listening to the Accredited Investors Only podcast, presented by Accredited Life.
All right, Matt, welcome to the show. How you feeling today?
Good. Thanks for having me, Peter. I appreciate it.
Hey, I appreciate you being here. So let's start with an introduction, Matt. So who are you? What are you doing? Why are you here? All that stuff.
Yeah, I'm the president, or founder, CEO of Verivest Fund Services. We are a fund advisory and admin company. I've been a fund manager many times over the last 25 years. And through that process, started about 10, 12 years ago, helping people think through and set up their own pooled investment vehicle. And then that led us to starting to do a lot of the back office work. So these days, Peter, what we really do is help syndicators, private lenders, people who are doing deals one at a time with using investor money and putting it into making the leap into a pooled investment fund. So that's really what we focus on: pooled investment funds, 506 Reg Ds, largely in the real estate and the mortgage pool space.
Gotcha. Awesome. So, like you said, there was quite the evolution there. What led you to the fund administration side of the business? Was that just where you date a guy, you like systems, processes, all the back end stuff attract you? Like, what was the catalyst for that?
Well, the catalyst was the great financial crisis of 2008 to 10, 11, 12. Really, at that time, we had our then largest fund that we had a large credit facility that we needed to pay off. So we were winding that fund down and kind of looking for our next evolution. And through that process, I had some people coming to me asking for help. Say, hey, Matt, I know you know quite a bit about running a real estate related fund. I'm thinking about setting one up. What do you think of this? And what do you think of that? And how should we do this? And so as that started happening, Peter, I noticed there's a lot of people out there, aspiring fund managers who need some help. And typically they go to, and this is exactly my progression, you go to a law firm, legal, drafts a bunch of documents, which of course you have to have, and they're important, but that's not, oftentimes the manager doesn't fully understand the reasons why they're setting it up or why the way that they're doing, not just the things you have to have legally, but the decisions that you're making along the way. Should it be open-ended or closed-ended? What should the economics be? Who gets what fees? How does it get carved up? What profit split should you have? How do you do the administration? How frequently are the distributions? How do you allocate profits and losses? All of those things are things that most managers, especially for the first-time fund, don't really understand.
Sure.
So we were able to provide a lot of value. We are able to provide a lot of value early on in the life cycle of a fund manager, helping them make a lot of decisions that they just aren't prepared to make because they've never encountered it before, that the lawyer views as the manager's decision, not really a legal issue.
Yeah, that's a really good point. That some of those things just kind of go beyond the scope of what a securities attorney is going to do for you, right?
Yeah, well, and look, the securities attorney understands them, but not from the perspective of the totality of what a fund manager deals with, right? I like to use this analogy, Peter, is that running a fund, the man is like, to run it smoothly, it's like a wheel, and that wheel has spokes, and the manager is at the hub of that wheel, right? And each spoke is like legal is a spoke, accounting is a spoke, capital raising is a spoke, origination is a spoke, underwriting is a spoke. Right, asset management, investor relations, accounting, administration, tax file, all of these things are spokes. So, but they're not the hub, right? And in order for the wheel to run smoothly, they need to be calibrated, right, properly So if you're relying exclusively on the counsel to set it up, you've got a really tightly calibrated legal spoke, but that doesn't mean the whole wheel is going to run smoothly unless that spoke is calibrated with other aspects. And I could give lots of examples of that, but look, lawyers are super important. Having a great securities lawyer is an absolute must. We know a lot of them. So part of our service, we'll bring people in, we'll make introductions, or if they have one already, that's fine too. But I think our value prop in the beginning of a fund is helping them set it up right in the first place, right? That's what led to the administration, was the advisory practice. So a lot of it, man, was, necessity is the mother of invention, as they say. And we were coming out of winding a fund down. We were trying to figure out ways to what our next iteration was, and doing that advisory work was something that we were able to provide a lot of value to people. And then people started asking, okay, now I'm live. Now what do I do? How do I allocate the income? So we started doing the admin for them, and that's what gave rise to our admin business. So these days it's a combination of advisory and admin. Our target market is new and aspiring, emerging, and small middle market managers from 0 to 100 or 200 million. We're not really catering to the, multi-billion-dollar funds that raise capital from, pension funds and institutional investors. We're catering to the relatively small and mid-sized manager who raises their money from accredited high net worth investors, and helping that manager, run a good quality operation with quality structure, quality admin, et cetera.
So you said a lot of times clients are coming to you after maybe they've done a few syndications and now they want to have the conversation. They think, they want to set up a fund. What do those initial conversations look like? What kind of questions are you asking? What kind of things do you want to see? What should be going through their head when they come to you, and what's going to be going through their head after they have that initial conversation with you?
That's a fantastic question, Peter. And I've had thousands, literally, of these conversations over the last 12 or 13 years with managers. But I do ask a lot of questions too, because my number one thing is, like, should they even start a fund in the first? It absolutely is not something that everybody should be doing. It's difficult. It's hard. It's a business unto itself.
Sure.
And there's a lot of things about it that people don't understand. So some of the questions I would ask is, all right, how many syndications have you done? Have you gone full cycle on it? How do you raise capital right now? How do you expect to raise capital going forward? What is your average deal size? What type of assets are you originating? How many do you think, if money were not an issue, how many could you originate in a given year? What does your team look like? How much infrastructure do you have? I'm trying to get a sense of how prepared they are for running a fund. And sometimes they're very prepared, and they're just nervous because it's new territory, and I encourage them to go forward. And other times they're absolutely not prepared, and I guide them toward, look, you should really think about doing some syndications or continuing on with your existing model, right? Because you're just not ready.
What would you say are some of the key differences between a syndication versus a fund that people should be aware of? And I think that could be great insight for accredited investors that are on the passive side of the business as well. What are some of those key differentiators?
Well, I define a syndication. It's a single individual investment. So it's an LLC typically that is acquiring one asset. In some cases, one or more than one asset, but it's all happening at one time. There's one close, right? The investors are all coming in, and then they're in that one deal. So I'd say some of the key differences are, from an investor perspective, you're exposed to the risks and rewards of that one individual transactions, for better or worse, right? And there's no diversity across, multiple assets. The upside for an investor is they can pick and choose which one they like, but that depends on the investor, right? Some people don't really want to have to deal with that every single time. And other people, are much more, they like picking and choosing which flavor of ice cream they want, right? A fund, on the other hand, I define as a entity or a vehicle that is acquiring multiple assets, typically at various points in time from different sellers or origin. I mean, in funds, funds could be real estate acquisitions, loans, private equity, venture capital, oil and gas. There's lots of different types of funds, but if we're talking specifically real estate funds, that would be usually then the syndicator is a turned fund manager is going to buy 3, 4, 5, 6, 8, 10 assets over a 2 or 3 year period of time, and they're all going to be owned by that same vehicle. Right. In that case, the investor doesn't get to pick and choose the assets. They're abdicating that authority to the manager. So, but the manager has to do that within a certain set of parameters that they articulate in the offering documents. Right. But at that point, the investor has diversity across multiple assets. I'd say the biggest difference is really the investors investing in the manager, their capabilities. They're putting a lot of trust and faith in that manager to make good decisions on their behalf around whatever the strategy is that's included in that document. Those are some of them. There's a lot more, but high level, I'd say those are the main ones.
Yeah. No, that's great, and definitely gives some context. One of the things I think that could probably make anybody's head spin, whether it's your first day or you've been doing it forever, is just how funds are set up with the distributions and things like that, and the splits, so the preferred return, the splits above that, waterfalls, no waterfalls, GP catch-ups, all that kind of stuff. Right. Talk to me about, I'm sure people wonder, why isn't there some kind of an industry standard? Why isn't it all done the same way? Why are there so many different ways you can skin that cat? Let's talk about that for a little bit, because I'm sure, I know it makes my head spin sometimes. I can only imagine. Yeah.
Mine too. And I've been
You're doing it every day. Yeah.
Thousands of funds and BPMs.
Yeah. What the hell is that about?
Yeah. Well, look, I would say there are some, I'll call them industry standards or some basic templates that you would sort of start with. And then from there, there's lots of variations thereof. I think some of what drives those variations are the type of assets that the manager is acquiring. So, for example, Peter, if someone's making loans and, the assets in the fund are real estate secured loans, that's a much different structure than if they're buying property with the money in the fund, right? The former probably is more conducive to an open-ended structure that has different characteristics than the latter, which is more conducive to a closed-ended structure, right? So the type of assets, the size of assets, the frequency of assets, the velocity of assets, whether you're using leverage or not using leverage, all of those things can influence the structure. The type of investors that you're going after can also influence the size and structure of a deal. Are you dealing with large institutional investors or individual retail investors? So there's just a lot of factors. There is no one size fits all. So, as much as people would like that to be the case, but that said, there's a finite number of variations.
Sure.
I would say that a lot of times people can get pretty fancy with, we're going to have multiple share classes and different splits, and we're going to have this split up to this IRR and then this split above this. I generally counsel people against that, because complexity just causes confusion. Confusion generally means people are going to be less inclined to proceed, especially in the beginning. Simplicity is very valuable. So that's part of what we try to encourage people is, let's not go too far off the reservation. I mean, there's things people are used to. Let's make something that people are used to. Yeah.
I like that. Yeah, the complexity, like you said, it leads to confusion. Confusion leads to inaction, that kind of thing. Right. Any tips for an investor on like how to kind of gear? Does this make sense? And I mean, is this somewhat industry standard? You know what I mean? Because and then you got to factor fees in too. You know what I mean? Because I would think there's sometimes you might see massive splits in one person's favor or the other, and the fees could maybe have something to do with that. So what would you personally kind of look for? What would your advice be for somebody for kind of just things to look for that may or may not make sense? I don't know if you mentioned it or not. I don't think you did, but like track record's another thing as well. Usually the splits start to go to gear more in favor of the GP as years go by, full cycle, deals go by, and they have more and more of a track record, right?
Yeah, that's exactly right. And there are a lot of different factors. I would say one of the things these days, there's a lot more information readily available, Peter, for investors. So you can go online and look in, Google, Perplexity, ChatGPT, ask a bunch of questions. What are normal fees? I mean, if you go on any AI thing, I mean, it's amazing the information it'll give you very quickly. What should I be if I'm an investor, what should I be expecting in the way of a typical management fee for a closed-ended fund acquiring, these kinds of real estate assets? And it will tell you, right? And then I could rattle all these off. I mean, the typical management fee is between 1% and 2%. And a lot of that depends on the size of the fund and the type of assets, et cetera. There's other types of fees, points or origination fees in the case of loans, acquisition fees in the case of, direct acquisition of property. If there's property management fees, potentially, some of these could be outsourced to third parties. Some of them can be done in a vertically integrated GP. So there's lots of variations, but I'd say the beauty of the internet, and particularly as artificial intelligence gains traction, you can find out very, very quickly what the answers to a lot of these questions are just by going online.
Yeah, that is so true. I like that you said that, because it's just, if somebody has the question, they at least have a place to start the conversation and start to get some information and all. What would you say is the some of the things that phone's ringing here. Hold on a second. I have so many questions for you. I'm trying to keep it like somewhat linear in what I'm asking as well, to kind of build on top of each other. That was distracting. Think. So
there's so many issues in running a fund, and I would say that as I went through the progression of running multiple of them, made plenty of structural mistakes that you don't really understand fully the implications of those until you actually live it and breathe it. And then as time goes on, right, you can clean those up. That's a big part of what we try to do, is come up with structures that are appropriate for the GP, that provide enough income for them to run the fund effectively in the first place, but also appropriate for the LPs, that provide, quality returns in a well-aligned structure and so forth. That is, it's tricky because it can vary considerably from one type of fund to the other.
Yeah.
But you're right, man. There's just an infinite number of permutations of little things that have downstream consequences that people need to think about, both on the LP and the GP side.
Yeah, it's one of those things where if you're obsessed with perfection, you got to know that's going to come in time, and really never at all.
There's no perfect structure. Right? There's trade-offs to be had. There's definitely better structures than others for certain types of funds, but there is no perfect structure. There's just trade-offs all along the way, and understanding what those trade-offs are is difficult to do when you haven't done it before.
Yeah. Talk to me about the difference between a closed-ended and an open-ended fund. What does that mean, and what does the investor need to be aware of getting into one or the other?
Yeah, an open-ended fund means that there are mechanisms for the investor to have the ability to redeem out of that fund at points in time along the way. So most open-ended funds don't have an end date. So another word for that would be evergreen, or their end date is very far into the future, but they do have a provision in the documents for investors to request redemptions, which are subject to the approval and the consent of the manager. And again, certain types of funds are much more conducive to being open-ended than others, namely debt, private credit funds, and loan funds are much more likely to be open-ended than direct acquisition of real estate, because those loans pay off more quickly. They tend to turn over, so you have more cash running through because the problem, of course, Matt, is like these are not publicly traded. You can't just press a button and turn it into liquidity, right? The money has to actually be in the fund, and there's restrictions for sale to other investors directly. You have to have the consent of the manager. So the fund needs to have the cash in order to be able to honor and accommodate that redemption. And it may or may not have the cash at any given moment in time, depending on what's going on in the market and with that fund. But at least there's the provision for the possibility of redemption. And I would say that reality is greater or lesser depending on the type of fund, the manager, and market conditions. The closed-ended fund there is no mechanism for redemption. You're just in it until the end.
Yeah.
And usually the closed-ended fund is between 5 and 10 years. So there's a disposition phase where they're buying the property. Then there's an execution phase where they're doing whatever the business plan is for the property. And then there's a disposition phase where the manager is selling off the properties. And as that's happening, they're returning the capital to the investors. But the investor is in for the life of that fund there's no mechanism at all for any redemptions.
Now, seeing as many as you have over the years, is there anything, I've had different LP advisors come on the show and give their kind of red flags or something they would run from or something like that. And sometimes I've had others say where there really isn't. It's a caveat. You got to look at the individual deal. There's not really one thing per se where if they saw that they would run. And one thing I've heard before is like the distribution of cash. And if it's going towards principal or not, first payments, that kind of thing. And I would think in a debt fund where you're constantly refinance, you're getting out of deals either through refinances or through the sale of properties and things like that. That's going to be, that money wants to be recycled essentially. So that might not make as much sense for that. And I would think too on hard asset funds sometimes where they want to refinance and then use that capital in order to acquire new assets and things like that. So are there any things, all these years in and all the funds you've seen where it's like you say 100% I'd advise against that, or you personally would say I wouldn't want to invest in something like that? Any kind of red flags or things that investors should look out for when it comes to that?
Yeah, it's super nuanced, Peter. I mean, so giving just one answer is very, very difficult because there's absolutely, I've read lots of PPMs where I looked at a guy, I would never invest in that. But they may vary for the reasons. I would say one of the things that I have seen is where managers if the manager has unilateral rights to do things that affect the investor's economics, that is something, if I was an investor, I would not do. Because then you're just relying completely on the manager not to change like the pref or the management fee or something.
Okay.
So I have seen those kinds of documents, and those I counsel clients against that. Like, you need to pick those things and you have to live with those choices. But things like reinvesting the proceeds of a disposition of an asset, that's very common, particularly in an open-ended loan fund.
Yeah.
Right. Because the purpose from an investor standpoint, they want to earn the income. They don't necessarily want to get paid back the minute something, sells. Now, in a closed-ended fund, during the investment period, which is usually 2 to 4 years, if the manager happens to sell a property early on in the life cycle of the fund, then it's still within the investment period. The documents will almost always say that the manager can use the proceeds of that to reinvest into another property. So I wouldn't, if I'm an investor, that's not an automatic don't invest in it. That's very normal.
Yeah.
So now look, fees, if somebody who's charging a 5% management fee, I would not counsel them to do that. And I certainly wouldn't invest in it if I was an investor. Fees are a big deal. Track record is a big deal. Structure is a big deal. Another one could be the breadth or narrowness of the investment mandate. I've seen some funds where the manager could invest in anything.
I know what you mean. Yeah. Anything.
Everything. Gas, media, film.
Yeah.
Right. Okay, that's probably not one if I'm an investor that I'm super comfortable with because it mandates too broad. Right. But on the other hand, too narrow a mandate is also not great because market conditions can change very quickly. And manager may hem themselves in to pass up on really attractive opportunities that might be perfectly within their wheelhouse. So a lot of these things, Peter, are there is no perfect structure. So I've seen things that I think are great funds that some investors will say, I will never invest in that. I've seen others that I would never touch that investors said, I love that fund. So there's one universal answer.
Yeah, it's so important to understand yourself. I mean, I did a post on LinkedIn today about knowing yourself because it's like you have to have your own buy box. Like you said, chances are who you're investing in is going to have their buy box, and it's probably not going to be the guy who's oil and gas and media and single family homes and self-storage developments or something like that. Chances are they're going to have a pretty strict criteria for what they're looking for, and maybe a little flexibility here and there if they're buying portfolios or something like that, or it's in their territory, location, it makes sense for that perspective.
Or they limit it to a certain percentage of.
Yeah, exactly. I've seen that. Yeah.
Things like that. So, yes.
Yeah. So, okay. Well, let's talk about the investors um, from an audit perspective. I mean, I think that's a question that comes up a lot. Do funds need to be audited? I mean, should they be audited? When do you audit? Because I would think the size of the fund absorbing the cost of an audit a lot of times doesn't necessarily make sense, but it can be kind of a mandator in that buy box for investors. And how is that going to restrict them from finding opportunities that make sense, or maybe finding certain yields that they want as well? Because when you add those expenses on, it just brings the yield down, right? So talk to me about your thoughts on audits, and when should we see them? When shouldn't we see them? Do fund administrators, do you do that, or do you step in with something like that? Or let's talk about that for a minute.
Yeah, so I would say I would recommend, perhaps this comes off as self-serving, but I do fundamentally believe this, that fund managers should use a fund administrator.
Sure.
And a fund administrator is not an auditor, so let's be clear. It's not that they're auditing the information, but they are looking over the financial goings-on of the fund. It reduces the chances of inappropriate things happening on the part of the manager, and it helps ensure that the manager is following the rules of the road in the operating agreement, which lays out how the money gets treated and dispersed in the waterfall, right to pref, the profit splits, the fees, etc. So, and then administrators are not auditors, but what they do, what we do and other admins do, is provide information to the auditor at the end of the year, which helps keep the audit costs down, because you're giving them the information prepackaged that they need in order to do the audit. So they're not having to spend as many hours, which helps drive that cost down. I would say, in terms of when do they need an audit, it's not a legal requirement typically for relatively small funds to have an audit, but it is certainly a best practice. To your point, if a fund is only $2 or $3 or $4 million, it's hard to choke down the cost of a $30,000 or $40,000 audit, and it's hard to get it. No matter how small you are, there's a minimum cost of an audit from an auditor, just based on the liability they're taking on, right, and some of the work they got to do. So it's hard to get an audit done for less than $20,000, $25,000. So I would, what we often see and recommend is that the manager put in the documents that they will get an audit once they've reached a certain size. So 10 million, 20 million, the fund shall be audited once it has reached an AUM at the end of a calendar year of X, right? Because then at that point, the fund can absorb the cost of the audit. The investors know that an audit will be coming if it reaches a certain size, but they don't have to do it if it's going to be too spendy when the fund is very small.
Okay, that makes sense. So just to really simplify, when an investor invests in a fund that's using a fund administrator, what should they expect that fund administrator to do? Because I'm assuming there's things that they're going to do, and then there's maybe things that they won't do necessarily. So what are some of the questions they should ask if they see a fund administrator on what exactly they do, and what are some of the things that they may or may not do, just because it was from an expense perspective? The operator said they're going to do this but not do that, all that kind of stuff.
Yeah, I think more than anything, Peter, the fund administrator is working with the manager, not the LPs. And so the fund admin's coordinating directly with the counterparty at the GP to gather the asset level information. So, because let's take a real estate fund. They buy 5 properties, right? Each property has its own income and expenses at the property level, right? And times 5. That information then rolls up into the fund vehicle. And then you have the treatment of the assets and the income and expenses at the fund level on behalf of those investors. That's really what the admin is doing, is taking the aggregated information from the individual underlying assets and producing financial statements and reports and statements for the investors, and then providing it. We would prepare them. We get them to the GP. The GP needs to review them and sign off on them that they agree. And then the GP would provide them to the investors.
Okay, and that's 100% standard. So if they're working with a fund administrator, the fund administrator is going to be putting those documents together.
The fund administrator is preparing now. There could be varying levels of what the GP actually wants the admin to do. Like in some cases, the manager might prepare their own financial statements, but they want the administrator to do the income allocation, based on the number that they came up with. Typically, the admin's doing both the financial statements and the income allocation in the investor statements, but sometimes it may vary a little bit depending on the scope of services that are agreed upon between the admin and the GP.
Gotcha. I would think just from an LP's perspective, they might have certain expectations of what gets done. I mean, but it could be worth a question to actually verify what it is they're doing and what that process looks like and that kind of stuff.
Yeah, look, I say there's a lot of confusion with both, frankly, managers, GPs, and investors over what fund admin really is. Because like most on the GP side, they're real estate people or lenders, right? They're not accountants necessarily.
Sure.
Right. So the scope of services and what it all looks like until they've run the fund for a while, it's a little bit ambiguous in a lot of people's heads. But at the end of the day, it's another set of eyes making sure that the numbers are being calculated properly. The income allocations to the investors are happening, according to the operating agreement. And it's very common that a lot of times, the admin is educating the manager on exactly how that stuff is being treated according to their own documents.
Yeah. What do you think about the state of the fund market in general right now? I've made some jokes that it used to be when I first started, 10 years ago, you go to like a weekend conference for, fix and flipping houses and stuff like that. And, you go to a real estate conference and the guy who was, driving Uber, he'd be, what are you here for? It'd be real estate. And I bought this property or that property. I'm doing this and that. Now I feel like in the last couple of years, it's fund to funds have become like the new house flipping almost. I mean, where you're in the Uber and your Uber driver manages a fund to funds and he's raising capital for deals now, and not just because really when you think about it, it's you have to manage contractors and things like that. You know what I mean? So what do you feel like the state of and I think there's been some issues with with multifamily over the last couple of years and the experience of the operator and their underwriting and their track record and that kind of stuff. So what's your thoughts on the industry? How has it changed since you've gotten into it over the years? How has it evolved, and where do you think it's heading if we can get the crystal ball out for a little bit?
Yeah, well, my crystal ball is not, super clear.
Sure.
Certainly more than anybody else's. And but I would say how has it evolved? I mean, the Jobs Act happened in 2013. That gave rise to the ability to advertise and solicit, which you could not have done, from 1940 until 2013. That means a lot of the rise of crowdfunding and things on the internet, and of course social media. So I think there's a lot more influencers and people out there who have gotten into passive income, investing in real estate, et cetera. There is no question that there are a lot more. Call them fund to funds or I call them allocators. These are privators, like somebody who's kind of got into the space, got enamored with it, figured out how it works, and then recruits other people that came from their world, doctors, dentists, engineers, professionals, executives, whatever, right? And then they aggregate money from those people and into an entity, and then they invest. There's a lot of questions about are those securities? Are they not? Do they need to be licensed? I mean, and you'll all kinds of different answers from different people about those things. But allocators have definitely become a thing in the last 4 or 5 years or more. Technology has grown dramatically in terms of the ability to. I mean, there's all kinds of investor portals that investors have access to. There's online, marketplaces that are trying to match, provide deals and match them with LPs and GPs. So it's changed in every way you can think of. I would say the dramatic increase in interest rate and the subsequent sort of softening of the real estate markets has had a big impact. Certainly, that has made it harder to raise capital because a lot of people have got money tied up in deals that either are never going to get their money back, or it's going to take longer than they thought it was originally. And this is true not just in real estate, but private equity and venture, et cetera. So, but that said, man, I mean, I still see tons of people that, again, not just in real estate, that want to set up a fund and run, raise money from other people to fund whatever deals it is that they're doing. So I don't see it going away anytime soon. I see it just, growing and morphing. I think some of the clarity around I mean, the regulatory environment, what happens there with, change in administration and all that. I do see the likelihood of it being more digitized over time
Yeah.
and going into tokenizing some real world assets, a whole other conversation that, is beyond the scope of this one, I'm sure. But so, yeah, I mean, there's a lot of interest, a lot of activity. It's been harder to raise capital the last couple of years with the higher interest rates and the softening of the market, but tons of people that are out there doing it in some way, shape, or form.
Yeah, I think what we were talking about it earlier, I think a lot of people maybe look at funds as if they're going to be easier to raise capital for, or I always got to laugh because it's just like, I don't know why they would think that necessarily. Like you said, in a lot of cases, it gives a little bit more discretion or in some cases, a lot more discretion over to the fund manager. Whereas with syndications, the LP can kind of more decide on their own which assets they want to have in their personal portfolio. And there could be pros and cons to that as well. But I always think it's kind of funny if people think that's going to solve they're going to be able to, the fund's just going to have all this cash in it so they can make cash offers. They can close quickly. What do you
see? How many times I've heard that, Peter?
It's like, I can imagine you probably hear it all day.
Oh my God. In the last 10 years, that one of the first questions back, you asked earlier, what questions do I ask? One of the first ones I asked is, why do you want to set up a fund?
Sure.
Like, what's your motivation, right? And if that motivation is misaligned, then I point that out straight away. And one of the most common answers I get to that question of why is like, so then I'll have the money sitting there and it'll be ready to go, and I'll be able to be more competitive with the seller of the property because they know I got a fund, and I'll be able to close quickly. I was like, dude, just because you set up a fund does not mean that the money's just going to show up. Man, it's harder to raise money.
I would think it's harder. I mean, and I've only ever raised money for funds and not individual syndications and things like that. But I would think it would be harder. I think the fund warrants more of a track record. More. How are you gonna execute versus raising, like you said, the operator matters no matter which side of the spectrum you're on, and they can mess a deal up, more so than anything. But the individual, the syndication, has a lot to do with those deal metrics and things like that. Not that the fund doesn't, but the fund, you kind of lean more towards the operator's ability to execute. They got to have some really good relationships to just be having millions of dollars sitting there at any given time that they can use to put a great cash offer in on something or something like that. Kind of in that vein, would you say there's any characteristics or traits that you find that good GPs tend to have that maybe others don't? And just, that's a general question, across the board from a capital acquisition execution. What are the good ones doing that the other ones that struggle maybe aren't?
Yeah, well, I think they understand clearly how they're going to raise capital when they start, and they're committed to the process of raising capital in a fund format and not expecting that somehow magically the money's just going to show up. They're willing to commit to building the muscle on the capital raise side of the business equally to the real estate or the deal side of the business and the other components of the business. And I'd say that's the area that most people tend to neglect the most. And neglecting it generally means that you're just never going to be really successful in raising money in a fund format. I mean, obviously, there's the others. They need to be good at what they do. They need to have integrity. They need to not be, slime balls. And they need to make good decisions. And look, even good managers can make, a bad investment decision, but like how they handle it, right? And how they react is important, obviously. But like, as it pertains to the fund side of the equation, I think the good ones take guidance and advice and set it up well to begin with to maximize their chances. And they devote the same resources to capital raising that they do to the rest of the business.
Yeah. You led in perfectly. I had this sitting here ready to go. This is in like where I record this. It's it's like a spare room. It's like a storage room, and books make their way into here when I need like something, and I have like there's something that jogs my memory of it, and this has been in here for quite some time. So I think of you every day, Matt. because I see this because I see this book all the time, and there's that one chapter, chapter 6, the importance of a written capital raising strategic plan that has been on my mind for years. Because I think Dave saw you at an event or something. You sent him, this book, and he got it for everybody back in the day, and it's just that's been on my mind for years. Because I think so many people don't realize. And I hear it a lot on social media, and I'm sure some people are actually telling the truth, but I call bullshit on a lot of people that they just post on social media and the money just comes in. And I find that hard to believe. 10 years in, I haven't been able to achieve that kind of success where it's just and it's like maybe they're only raising, $1 million here or 2 million there or something like that. But to raise real money, you need a plan, and you probably need to have a budget as well, unless you have some fantastic network and that kind of thing. So if you wouldn't mind, I don't know how long it's been since you've thought about that kind of stuff and all, because what you go after now is different, right? Whereas your client is more operators than it would be, like you said, LPs. But speak to me a little bit about that side of the plan, because I think that's such an important aspect that people just think, and it's not wrong that they think that way, because probably they've been told that if you got a good deal, the money's just going to come, right? And that hasn't been my experience. So talk about that with me for a little bit, if you don't mind.
Yeah, I mean, well, I do think that this question came up at a conference I was at last week, is like, what do you put first, the deals or the money? Like, well, they're kind of like both sides of a scale. You've got to have them in balance at all times, and it's easy. They're almost never like perfectly in balance.
Yeah.
Right. But I would say if you don't have deals, then you don't need money. Right. But if you have good deals, that doesn't automatically mean the money's going to come there. But if you have good deals, that I'd say that does precede. Because there's no point. I mean, what's the point if you don't have the ability to originate and underwrite and acquire, good assets of some sort, whatever it is that you're doing, whether it's real estate or mortgage loans or private equity or business loans or oil and gas or whatever. Right. So I do think that's important. The second thing I'd say is that people have a propensity, in my experience, to not really understand what they're likely to be capable of when it comes to raising money. So there's a lot of delusion about people's ability to go in and raise money from institutional investors or even from intermediaries like broker dealers and registered investment advisors. Those are very difficult markets to crack.
Sure.
I think people need to understand what their investor base is. And for the vast majority of relatively small managers, it starts with friends and family and it works its way out from there. But it's high net worth accredited investors and maybe some small family offices and some small, institutional, quasi-institutional investors, insurance companies, local, smaller pensions and things like that. But even that's hard. So I just think the biggest thing is know who your base is and, embrace it.
Mm-hmm. Yeah. The two things that I think get thrown around a lot in this business is, people building relationships with investors, what does that actually mean? And then track record, it's like, what is that? How do you actually show that? You know what I mean? What have you seen from a track record perspective that you feel is more maybe impressive than others and that kind of thing? Because I always feel like you can get so into this business where your head's so down and focused that years can go by where it's just like, when somebody asks you, okay, what's your track record or whatever, people don't know what to show you, you know what I mean, or how to document that. Any advice there for somebody that's they're maybe on the syndication side of the business, so they have some deals. Some of them are gone full cycle. Some of them are maybe in the process of being executed on. What are some of those kind of things that you actually want to see from a track record standpoint, instead of just kind of talking about it, right? And just saying, hey, here's some vanity numbers or something like that.
Well, I would say the earlier in the lifespan that the GP can be tracking all of their results, the better, and then have documented proof of those results and track it in some sort of a spreadsheet or whatever that you can show so that you don't have to go back and try to recreate it later.
Yeah.
Right. I mean, it took us years. I mean, we didn't do that early on and then went back and it took a long time to recreate it. And once you did, keeping it up to date's not as
Yeah.
hard.
Yeah.
So the earlier you can start doing that, the better.
Yeah.
Right. That there are restrictions legally on what you can and cannot use as a track record, for a new offering, and people need to be cognizant of that. And I am not a lawyer, and this is not legal advice.
Sure.
And people should always consult with their own counsel on what they can and cannot do. But if you were offering it through a broker dealer with registered securities, it's very strict on what you can and cannot say or do for track record. If you're the issuer, of the securities, and you're not running it through a BD, you're still subject to those same rules. But I would say people disregard them or don't understand them all the time. But part of the trick then is, if you're starting a fund for the first time, how do you extrapolate your track record on individual deals, toward the fund? Presumably, the fund is going to be doing similar types of deals to what you did before. The only difference is that you have full discretion as the manager to do them. So, there's ways to try to extrapolate that out and still stay within, the rules of the law on what you can and cannot do. But I'd say the biggest tip is just track it from the very beginning.
Yes.
You don't have to go back to try to recreate the information, because that's hard.
Yeah. Yeah. I completely agree with that. I think that is definitely one of the best tips. And if you haven't done it yet, do it now. It's like planting the tree, right? It's going to be a lot easier to do it sooner than later. And the best would have been to do it from the start. In that vein, talk to me about models around a fund. And I don't know how much a fund administrator would really get involved in that, but I feel like the fund, more so than a syndication, it's nice to have a model, but there could be so many variables within a model that makes it a lot more difficult for a fund. And I'm sure the last thing most people want to do, like you said, if they're not, just a scumbag, is they don't want there to be surprises, and they don't want to set non-realistic expectations. But I feel like a syndication with a strict business plan of, we're going to do this and we're going to sell it then. Whereas a fund, there's just a lot more variables there that a model, it's hard for a model to factor all that in. What's your take on that?
It is hard. I mean, I think it's worthwhile to prepare one, but as you know, Peter, with models, is like the one thing that you can be sure about on a model is that it'll never be accurate, right? Because
it's not going to look exactly like this, right?
Oh, I mean, but you're making a lot of assumptions that you believe to be reasonable. And, so it's helpful in putting it together. I'll give you a great example. I mean, I'm working on an advisory engagement right now for a client, and this is a large mortgage shop in California. They have 200 or 300 originators. They've been brokers for a long time. They're setting up their own mortgage pool fund for the first time. They've done a very extensive model. Part of my engagement is to review that model and help them determine, does this model look right or not right? So it'll never be right.
Sure.
But what it does do is give you a lot of information about how to think about it. And there are definitely things that people don't factor in oftentimes. For example, cash drag, right?
Yeah.
You're going to get paid off on certain loans. And if you don't deploy that money very quickly, that money's sitting in the bank account and it's only earning, whatever, 3 or 4%. For a long time, it was earning nothing.
Yeah.
Right. Instead of 10 or 12% or whatever the note rate's paying. So if you sit on cash for too long and too much cash for very long, it's going to drag the yield down significantly. So how do you build that into the model? Because you don't really know when all the loans are going to pay off exactly. I mean, kind of, but you don't. So there's lots of things, to your point, in a fund model that are harder to predict accurately. But it's still worth the exercise to give you a sense of what you think the income and expenses are likely to be, and how the performance of that fund is likely to pan out, at least within some reasonable range.
Yeah, I doing models for us over the years has been just an amazing opportunity to get to know what you do better. And to challenge yourself and to ask questions and to make those assumptions and all that kind of stuff. So I completely agree with you. I think it's a great exercise to go through. And it just leads to really good conversation, deep conversation with investors that are interested to learn that kind of stuff around, it just helps you to better understand everything and to express some of the risk and variables that could come up, all that kind of stuff. So Well, Matt, this has been a great conversation. There's so many, there's so many questions I have for you. I feel like, I'm satisfied with what we were able to talk about and all that kind of stuff, because I could talk to you all day. So I appreciate you being here. For people that want to learn more about what you do, get involved, follow your content, all that kind of stuff, how can they do that?
You can find me on LinkedIn. Is pretty active on LinkedIn. That's a great place. It's so just my name, Matthew Burk, Verivest on LinkedIn. You can email me, matt.burk@verivest.com, and there's no E on the end of Burke. So if you put an E on there, it won't go through.
Hey, as a guy with Neil with 2 L's, I know exactly what you mean. I think I even have the email that's P Neil with 2 is my usual email, but I think I also have the one with 1, and it forwards to my email because I've learned the hard way.
Yeah, that's a good idea, man. I might have to.
You should do that. Yeah, you'll be surprised. You'll get those forward emails every now and again. You'll think, wow, good thing I did that. Well, thank you, Matt. I appreciate you being here.
Of course, man. My pleasure. Thanks for having me.